We started by noting some very positive developments. The Canadian economy continues to operate near its capacity, and growth is relatively broad-based across sectors and regions. Meanwhile, inflation is close to our target. So what stands out is that even with today's increase in the policy rate to 1.75%, monetary policy remains stimulative. In fact, the policy rate today is still negative in real terms. That is, once you adjust for inflation. Given this context, it's natural that our discussion centered on the main factors driving economic activity and inflation over our projection horizon, and the appropriate pace for returning the policy rate to a neutral stance. Now, let me remind you that our estimate of neutral is in a range, currently 2.5% to 3.5%. It's a range rather than a point estimate because the neutral rate is unobservable and it can change over time. So let me talk about our assessment of inflation developments. Inflation was running near the upper end of our 1% to 3% target range in July and August, a little higher than we had expected in our July monetary policy report. And as we said in our last interest rate announcement in September, the staff assessment was that most of this surprise came from one component of the Consumer Price Index, that's airfares. They judged that this component would be volatile over coming months because of methodological changes that Statistics Canada put in place. Well, the staff were right. The most recent data released just last Friday showed that inflation fell back to 2.2% in September, due in large part to a reversal in the airfare component. We could see further volatility from this component in coming months. Closer to home, Governing Council has been assessing how people are adapting to both higher interest rates and the changes to mortgage underwriting guidelines implemented earlier this year. We've seen that households are adjusting their budgets largely as expected. We understand that this can be difficult, particularly for those who are highly indebted. At the same time, employment and incomes continue to grow, which can help to cushion the adjustment process. Further, the quality of new debt is improving, and housing activity is moderating to a more sustainable level. All of this is making the economy more resilient and reduces the chances of painful outcomes for many people further down the road. The rule changes also appear to have helped take the wind out of the sails of speculators in some markets, which reduces the pressure on housing affordability. Overall, while financial system vulnerabilities are still elevated, the fact that they have stabilized and edged down in a number of respects is positive. Given all these factors, Governing Council agrees that the policy interest rate will need to rise to a neutral stance in order to achieve the inflation target.